Thankfully, nobody was involved in any fender benders today with the White Death here in Cincinnati. Not much announcements as far as upcoming stuff. Next month, we have somebody lined up. His name is Chip Dinglinger. He's with, get the letters right here, DCS Technologies. They do printer support and services, and they're going to give us some info for IT guys on how to, I guess, recognize and do some initial first-line troubleshooting for printer issues. Tonight, I'm going to introduce someone to do the introduction of our real speaker. So Ian is not the speaker, but he's asked if he could do the introduction. So good luck. Mark, I don't know what he's got.
Yeah, I'm Ian Liddell with Summit Funding, and we do equipment financing and IT. So Mark and I had met several years ago.
Wait,
Am
stop.
I in the middle?
No, I forgot something. I apologize. Eric brought something up to me earlier, and I said this would be like good information for the whole group. So let's just stick that around, and would you mind sharing?
No, I won't mind at all. Right now, I'm working with 6 organizations who have had Office 365 account takeovers, and so we're all of these were like highly privileged accounts, global admin accounts, and 3 of them are banks, and we're used internally. So Microsoft advises that global admin accounts be separate accounts and not tied to a regular email address. And in every case, you start dealing with small businesses or even medium-sized and large organizations that are banks. The CFO or the president wants to be a global admin. Really bad idea, because they also tend to be the people who have really poor password policies and use the same one everywhere else. So with all of the accounts and email addresses, email and passwords, a lot of password reuse, or in some cases now we're seeing people actually taking a look at the online passwords, and if they see a pattern, they can guess that. So, some people just increment, oh, I have a different password for each site. Yeah, well, it's the same. And so in any case, right now, this is a big enough deal that Microsoft put out on their Office 365 admin some best practices and enable multi-factor authentication. All of that stuff is just really important, because I can't believe that we've had that many this fast. And typically, if they get a global admin account, they'll give that global admin permission to 10 or 15 other accounts inside the organization, so they can do reconnaissance. Then they start the wire transfers, because once they've got reconnaissance, they can search the mailboxes, and that's all done with the OLA login. So if you don't need that, that should be turned off also. So just grab the best practices documents and implement them.
Thank you.
Very good. So anyway, Mark and I know each other for many years, actually, and kids, both boys that grew up in the Mason School District. So we originally worked together maybe 10 or 15 years ago. Mark was an owner of DLP Technology, and we did some projects with Mark at that point, and kind of stayed in touch over the years. And we've actually done a couple of projects since then with a company that Mark was with, including Rick Hartlaub, a project last year. So anyway, with the new tax law, I'm in the equipment finance business, and with the new tax law coming in place at the end of the year, I thought I was trying to think of somebody who might be a good resource to talk about this. So Mark and I talked maybe about 2 months or so ago about the project. I think originally the idea was to talk about some of the 10 areas that businesses mistakes they may make, but I think kind of some of the things going on with the new tax law would be a good topic for people to be aware of some of the changes that have been made in terms of how it affects businesses with Section 179, and also some of the changes in terms of different tax rates. So there are a lot of things out there. So I thought it would be a good opportunity to have Mark come in and talk a little bit about what's going on. So thanks, Mark.
Guys, thank you so much for having me. It's great. Just to start off, how many people, raise your hand if you figure you're getting all the tax deductions you're good for. You're in shape, you've got 100% of your tax deductions.
My mother-in-law does my taxes, so.
So yes, absolutely. You get every possible deduction.
Right? Yeah.
Okay, other than your mother-in-law, how many people have their financial advisor, their tax person, reaching out to them for proactive tax advice? Well, that's good. That's good. If they're reaching out, that's fantastic. Well, you're probably right, except for you, sir. You're probably not getting all the tax deductions. Don't worry about it. We're going to talk about today some of the new deductions as part of the new tax act. And I know we're not doing the top 10 tax mistakes of small business owners, but we're going to hit about 4 or 5 of them also, just to make sure you guys can meet the low hanging fruit. My name is Marc Steiger. Robin and I together own a company called Untitled Technologies. In about 11 years, we about doubled the revenue. We increased the value about 7 times. So we did well, but we had all the issues that all the rest of you guys have. You know, utilization problems with engineers, problems with margin on resale, clients that would call and curse at us, clients that would fall in love with us. Sometimes it was the same client, right? It was crazy. People yelling 5 minutes later, they were singing your praises. So tough business, I understand. And at least I'm not a technical person, but I certainly know some of the issues. So we're not going to just go through the rules here. Obviously, from our Chief Justice, past Chief Justice, we're activists. Nothing wrong with strategy to avoid the payment of taxes. Internal Revenue Code doesn't prevent that. You're allowed to be aggressive with taxes as long as you stay. Somewhere in America, I'm reading my notes here, there's somebody teaching a bunch of accountants how to do taxes, the new taxes. And that's great. They're learning how to do the right line, right number on the right form, on the right line on the right form, and how to do tax preparation. But I think what you're looking for is not just tax preparation for next year, but good planning so that you can make sure that your taxes are low. All right. So, new tax law for 30,000 feet. I believe that the reason that they came up with this was really to save money for big corporations. The thought was that international corporations, we had too high of a tax rate. Some of us might disagree, but that was the idea. And the big thing was to lower the tax rate from 35% down to 21%. To get that, they gave a lot of goodies to the rest of us. But a lot of those goodies, the individual things, only last until 2026. So we're going to start with individual changes, but they might, in 2026, somebody's going to have to either continue them, or they're going to go away and we'll go back to the old system. The corporation's got a permanent. So any of the business deductions are permanent. So just to start talking about how the tax system works, if you think of it, I don't know if anybody's seen a 1040 form, just computer built form. You start up with adding your income from all sources, that's the top of the first page. Then you take adjustments in income, that's the bottom of the first page. You get to adjusted gross income, it's a correct number. Flip the page over, then you have either standard or itemized deductions, whatever's higher. There's a lot of changes in both the standard and the itemized deductions as a new rule. Then you look at the table of tax brackets. You have your tax credits. You subtract that from the tax. There's additional taxes you have to add. And finally, you write a check, or if you're lucky, you get money back. 4 keys to cutting tax, timing issues, shifting, code, and product. So timing is things we do like putting money into a 401k, right? You take money from now, income from now, we shift it to later, where hopefully we have a lower tax bracket. Income shifting is talking about we shift income to maybe kids or your parents that are in a lower tax bracket. A lot of times when we're doing paying, we do that with entities also. We take it from a high tax entity and we shift the income to a low tax entity. The multinationals do a lot of that with shifting it from high tax America to lower tax foreign countries. And that's the issue. There's code tax cuts, and that's just things that are in the tax code. That's probably what we'll talk about most today. And there are products. I know, the investment guys will sell partnerships, gas and oil partnerships that'll help you save money on taxes. Has anybody ever been promoted one of those gas and oil partnerships to save money on their taxes? All right, that's good. If you guys are in high income,
heard of that.
I've never heard of that. Well,
I've heard of people like calling, going, "Hey, you want a timeshare?"
Well, no, that
Yeah.
stay away from
They
that.
both sound like sucker deals.
All right, so what's an income? We have earned income. This is simple stuff. Earned income is what we have that, you earn money at the job. Business profit and loss is if you have like a partnership or an S corporation or a sole proprietorship, that's your share of the income. Interest and dividends, capital gains, that's usually at a lower rate. Pension and IRA money, that's income that you bring in from, that becomes taxable when you retire. Alimony, that's a big change. I'll talk about the next slide. Obviously, gambling winnings, that didn't change. We still have to pay money on gambling winnings. And illegal income. So for any Bernie Madoff wannabes in here, any illegal earnings, you still have to pay taxes on. The government really doesn't. The IRS doesn't care where you get your money from. They just want a piece. It's like the Godfather. The good thing is if you're like you get to deduct business expenses. So if you're a cat burglar and on your way from the museum where you took the painting to your hideout, you can deduct the mileage. They don't care as long as it's business, as long as it's income. They don't.
Who's going to steal cats?
Well, isn't that what they call those guys that do that?
Yeah.
I don't know. All right, so adjustments in income. So some of these have changed. So they're back in 2017, there were IRA contributions, moving expenses, 1/2 of your self-employment tax was an adjustment, self-employed health insurance and retirement contributions. The reason you have to take, if you work for somebody else, it comes off of your W-2, but if you're self-employed, you have to do it on front of your tax return. Alimony paid was a deduction, and student loan interest. So what's changing is moving expenses and alimony paid. Moving expenses will no longer be a deduction unless you're a military member. That's it. Moving expenses is gone in this year. Alimony is still good for this year, but next year, any divorce decree that happens next year, it will not be deductible to the higher earner, and it won't be part of income to the lower earner spouse. So what does that mean?
Most of Congress got a divorce.
Well,
That's why
anybody who's a higher income earner right now is going to try to get their divorce done
Oh.
before the end of the year, and any lower income spouse is going to hold off and delay. So we can get a lot more lawyer fees in that argument. I guess it was Congress's way of giving a little money to the lawyers. All right, so you guys have heard of this, I believe. Standard deduction is just about double. If you're married joint, went from $12,700 to $24,000. If you're single, went from $6,350 to $12,000. Sounds great. What they don't tell you is you also lost your exemptions. So if you're married jointly, you used to get $4,030 of exemptions per person. So yes, your deduction went from $12,000 to $24,000, but you lost $8,000 of exemption. So it's more like $20,000 than $24,000. Not as great as it seemed. And if you have kids, you lost all their deductions also. But there's a way they try to make it. Hey, if I'm going too fast or too slow, let me know. All right?
you're great.
Oh, thank you. I will pay you later for that.
All right.
All right, so itemized deductions, so they increased the standard deduction, but itemized deductions, there's a lot of changes in it. Medical and dental, they actually increased this a little bit. There was a floor of you could only deduct anything over 10% of your adjusted gross income. And they moved it back to 7.5%, so that increased the deduction. But for 17 and 18 and 19, I think it goes back in 2020.
So they're lowering the amount we can deduct, is what you're saying?
No, they're increasing the amount. They're increasing the amount you can deduct on medical expenses. It's still not the greatest way to do medical expenses, especially if you have a business. You're a small business, there are other things we can do that so you can deduct all your medical expenses, and also one of those health savings plans, health savings accounts is a better way to deduct medical expenses if you have a high deductible insurance. State and local taxes, this has been very big in the rules. Limited to $10,000. So that's your property taxes plus your local taxes plus your state taxes is limited to a max of $10,000 deduction. Even in Cincinnati, we have a lot of middle income people who are seeing $20,000 and $30,000 deductions. So that's really going to cut back the value of those itemized deductions.
So what's the workaround for that?
There is no workaround for that.
Don't buy a house.
There is no workaround. They're giving in one hand and they're taking away on the other. It's pretty bad for us here in Ohio. It's terrible for the folks in New York and California. And I know the states are trying to do a workaround. I've seen two areas they're going to do. One is to come up with a charitable deduction. That's basically a charity that gives money to the state and you get a credit for that. I don't think that's going to work. I think in the current law, that's already not allowed. There's another thing where instead of taking income taxes from employees, from workers, they're going to do a payroll tax for your employer. That'll work, but I don't think most states want to do that because it'll be a straight tax, it'll be a flat tax, it won't be progressive. So there's some ways that we can get that the states can get around. Foreign taxes, same as always, you can deduct taxes that you paid on any of your dividends and interest that were charged by a foreign government. It's a lot more complicated for the companies now, but I don't do a lot of foreign work, so interest is limited. It used to be on you could take up to $1 million of acquisition debt on a company, on a house. So if you bought a house up to $1 million, that first $1 million you could deduct the interest plus $100,000 home equity line, even if you didn't spend it on a house. That was deductible. That's changed for any new house you buy. Starting actually December 17th of last year, anything up to $750,000. Again, not a big difference for us in Cincinnati.
The value of the home or how much the tax is paying?
No, it's the value of the loan.
The value of the loan.
The value of the loan.
Okay.
Now, the $100,000 home equity, that's gone. That's gone. So, you can't deduct home equity now for anything other than the acquisition of the house. So again, you can see they're limiting these itemized deductions. Casualty and theft losses. We used to always have a couple of people every year, and someone that wasn't insured, and they lost, somebody stole something, or they lost money on a loan. We were able to deduct that. No more. The only casualty and theft losses we can take now is if it was a federal disaster relief. Charitable gifts. You can still give charity. In fact, you can give more charity than in the past. Used to be a limit of 50% of your net income you could give for charity. Now it's 60%. You say, well, who's going to give 60% of their income as charity? You'll see some older folks who have lower income but lots of assets. And finally, this is the big difference for a lot of my clients. These miscellaneous deductions are gone. So if you're a salesperson and you deduct all your extra miles, or you're only reimbursed half of the mileage rate, or your company doesn't reimburse you for all of your meals and entertainment, we used to be able to, or you have a home office, we used to be able to take a miscellaneous deduction. Gone. My fee used to be a miscellaneous deduction. They could deduct it. Gone. My clients are not very happy about that. Registered investment advisors, that 1% fee on assets under management. That can be a big number when you're retired. absolutely gone. So those deductions are no longer with us.
So taking clients to lunch, that kind of stuff.
We're gonna get to that later, but your business, it's different for you. We're talking about itemized deductions on an individual.
These are 1040.
These
This is
are
all
1040
1040 stuff.
Okay,
Okay,
you all individually own a business. So what does that mean? It means if you're a business, you have employees, and you're not reimbursing for everything, they're gonna find another job. And it's more of a reason to be in business. So again, all these things are designed to make it simpler. When you hear simple, it means there's less choices. And really, if you work inside the box, if you don't have your own company, if you work for somebody else, if you just have a couple of W-2s, if you have 1.8 kids, it's going to be, the taxes are becoming much more simple. There's going to be a lot less people itemizing. Of course, if you're outside the box, if you have a business, it's even more complex. All right, here's the tax brackets. Here's the new tax brackets. There's 7 brackets now. There were 7 brackets. As a rule, we're saving, the brackets are wider, so that means you're getting the lower tax rate for more of your income, and you're saving about 2 to 3% every rate. There's an exception, like married filing joint between, look at my notes, but like 315,000 to 400,000, there's like an $80,000 chunk there where you actually pay 2% higher. So they're still doing better on the rates.
One thing you might want to mention is most people assume that if they make 100 grand, that they pay 24% on all the money when they don't.
Right. So everybody knows how the brackets, thank you. The brackets work like a layer cake, like an old-fashioned wedding cake. So I have a lot of clients come to me and go, wait a second, I'm going to move from the 24 to the 33% bracket. I'm going to lose money. And I go, no. It's only at any dollar over 157,000 that you're going to pay 33% on. You still pay the lower rates on the lower tiers. Let's go through a couple examples. Credits. Not a lot of changes in credits. Family credits, education credits, foreign tax credits still there.
Does education mean loans? Or does it mean?
Yeah, the loan interest credits are still there.
That's what that means? Okay.
Yeah, let me hit my thing here. So let me see if there's any changes here. The big difference is the family credit in, remember I said they took away the exemption. So everybody had a $4,030 exemption. So for every child you had that was a dependent, your income went down by $4,030. That's gone. So to make up for it, they expanded the child tax credit. It used to be a $1,000 credit, and you could only take it if you had income up to about $100,000. It's not the exact number, it's the range. So they've expanded that. Now instead of a $1,000 credit per child, it's a $2,000 credit. And it's good for folks that have joint adjusted gross income up to $400,000. So a lot more people are going to get the benefit of that credit. That's the good thing. The bad thing is the credit's only good until you're 16. Once you go to 17, you lose that credit. Think about anybody in the house, in the place who has teenagers or had teenagers. They're 17 years old. You're paying an enormous amount of money for their driving insurance.
And their
Plus
food.
the tax credit. And let's face it, maybe
So
my kids,
It's 2 years, or was 18 before, or was it?
it was up to 23 if they were in college. So, and I don't, when I had teenagers, they weren't the bundles of joy they were at 8, 9, and 10. So, somehow, the government made having teenagers in your house even worse. All right. What about the additional taxes? So I said there's always additional taxes. So self-employment tax, which is a completely separate system from the income tax. There's net investment income tax, called the NIT tax. That came along from, I'm sorry if I'm messing up the camera. The NIT tax came along with the American Care Act. Some people might know that as Obamacare. And that was a tax on high-income people on their investment income. 2.9%. Alternative minimum tax kind of went away. They totally took it away from corporations. Somehow for individuals, they didn't totally take it away, but a lot less people are going to have alternative minimum tax. One, they increased exemptions. Two, they took away all the standard deductions that caused most of the alternative minimum tax. Most people who had alternative minimum tax is because they were coming back and they were recapturing all those state and tax deductions and all those interest deductions and all those miscellaneous deductions. Well, they've limited them. So for most people, we're not going to see alternative minimum tax, even though it's still there. And then that pesky nanny tax is still there if you have.
I mean, you pay for childcare.
Nanny tax is if you have a child care inside your house. So, you know, if you've got, it's not just for nannies, it's for your elderly folks, and you're paying for any kind of household employee. Right? Who has a butler or maid or so most of those are the same, and we're going to go over self-employment tax. It's not something new, but there's a great way to save money on self-employment tax if you have a business. All right, so here's a case study. Here's a couple who's married with children. They make $100,000. In 2017, they had itemized deductions of $24,000 and a standard deduction of $12,700. So obviously they took the $24,000. In 2018, their standard deduction went up to $24,000, but because of the limitations, their itemized deductions are only $22,000. So in 2018, they won't itemize, they'll just use a standard deduction. However, they're going to lose, they've got 2 children, they're going to lose $16,000 in personal exemptions. So actually, their taxable income was lower in 2017 than it was in 2018. And their tax before credits is lower in 2017. So it looks like this new tax law wasn't good for these folks. However, the child tax credit doubled. So in effect, they end up paying about $1,300 less in taxes. What's that? That's about $350 a day. So you're not going to make a ton of money on that, but it's a little bit. I will tell you that we've had, it's about third week of tax season for us, and everybody who's come in for an appointment, we've done a little projection for them. At this time of year, most of the taxes are simple. It's mostly folks making under $100,000, W-2 wages, and I've yet to see, everybody's been about $1,000 to $3,000 in projected savings. It's not much, but my clients are thrilled. For some folks that are only paying a couple of $1,000s in taxes, it's a significant decrease. Here's another case study, retired folks. So about $60,000 in pension income plus $20,000 in Social Security, $80,000 stays the same. Same kind of difference. Their taxable income goes down. In this case, taxable income goes down in 2018. Their tax before credits goes down, and they save about $1,700. Nice. Not going to become a millionaire, but it's a nice little thing. All right, here's something that hit us that nobody was expecting. So kiddie tax. Has anybody heard of the kiddie tax? So we talk about income shifting. This is not the right way to income shift, but a lot of folks who had, let's say, P&G stock, and it was doing maybe $10,000 a year in dividends. They had a lot of stock there. Maybe $1,000 a year in dividends. You're in the 25% bracket, you're going to have to pay $250 on that $1,000 in dividends. However, if you put the stock in your kid's name, who's 3 years old, they don't have it. You're at the 0% bracket. So you save the 25%. You save $250 by shifting that income. Well, the government also realizes that. So they had a rule that if it was over, I think about about $2,100 in investment income, you didn't get the benefit of the lower bracket. You had to pay at the parent's rate. All right. Here's what happened. They changed it from their parents' rate to a trust rate. So now you have to pay trust rates. Why is that a big deal? Well, trust rates are high. Trust rates start at 24%, no 12 or 22 or 10% rates. Then they jump up to 35% if you've got $9,000 in income, and 37% with $12,500 in income. You didn't even make it $500,000 a year as a single person to pay that money. So what does this mean? If you've got children or you've got grandchildren, get those assets out of their name. Use a 529 plan, put them in your name. Use some kind of use a product like an insurance product to defer the income. Get them out of your kid's name. This was sort of a gotcha. We didn't see it coming, and it's a big deal. And I have a lot of clients that, they're older, and they'll bring me a stack of dividend statements. Oh, this is not for me, this is for all my kids, my grandkids. So the parents don't even know it's coming. They haven't told their grandkids they're getting this. Big deal. Big deal.
So are trust tax rates high because the IRS doesn't want people to have trusts, or what's?
So trust tax rates are highest because they used to be a planning tool. So we used to we talk about income shifting. So we used to shift income out of personal taxes into trusts. So this is a way, so they make trust rates high so you wouldn't do that. Also, trust fund kids. So, these are kids that aren't working, people were money, they're getting money from trusts, so they try to make the tax rate high so they can disperse the income into the individual. And it's also legacy, right? Because these were set up back when personal income rate taxes were high. All right. So that's about the end of the individual stuff. Any questions? All right. How am I doing? Is it interesting?
You're doing great.
Yeah.
How's the fun stuff? Because I said they're making it simpler, right? It's not a postcard, but they're making it simpler for individuals. Wow, do we have stuff for businesses? Oh. All right. So, 4 kind of business entities. You've got a C Corp, an S Corp, a partnership, a sole proprietorship. There's other entities, but you don't see them. They're big, weird entities. I know what you're thinking. You're saying, well, wait a second, I have an LLC. Why isn't the LLC on this list? Well, the LLC is a state idea. It's not a federal idea. And the LLC is what I call the Swiss Army knife of entities. As an LLC, you can elect to be any of these. If you own it yourself, you're a sole proprietor. Unless you tell the government, no, treat me like an S Corp, or treat me like a C Corp. Same thing if you have a partner. You're more than one owner of an LLC, you're a partnership. Unless you tell the government, no, I decided I want to be an S Corp or a C Corp. So an LLC can be any or all of these items. But for the federal government, you elect one of these items and it's treated as this. A lot of my clients start as an LLC, and then as they have tax needs, we elect to have one of these items. So before we talk about the new tax law, I want to hit how important entities are. That was cool. I didn't know that was going to happen. All right. So audit paranoia was the number 2 item of the top tax mistakes. This is from 2014, I believe. So in 2014, audit rates dropped about, probably lower now, but they dropped very significantly. This is only for business entities. If you notice, a Schedule C person, a sole proprietor, has an audit rate of over 2% if you make over $100,000. All right?
Schedule C means sole proprietor?
This means sole proprietor. All right? Or an LLC that's active, that hasn't elected something else.
Because there's that form they fill out every year, elected to perform as an S Corp kind of thing?
Right.
Okay.
That's actually should be once, but
Okay.
that's right. So if you're a Schedule C, over 2% risk of audit. Partnership or S Corp, 0.5%. So just, even if you don't have any tax savings, if you sort of want to run under the radar, it might make sense to choose an entity other than a sole proprietorship. That's not new. That's from before the new tax law. The next slide, I wanted to compare another idea of entities. I'm going to compare a proprietorship and an S Corp, just to show you how it can save money on self-employment taxes. I'm not telling you to become an S corp. I'm just showing you why choosing an entity is really important. So here's a proprietorship. It reports its net income to Schedule C. It pays income tax on the net income, but it also, so we have additional taxes, pays self-employment tax of 15.3% on its income.
I mean, Social Security.
Social Security, Medicare, both the employer and employment portion. So let's say we have somebody making $80,000 a year net. Reasonable amount of money. They pay income tax on it, but in addition to the income tax, they also pay self-employment tax of $11,304. I can't tell you how many people come to me after their first year of business, and I do their taxes, and I have to run to the fridge and get them a beer because they're ready to cry at my desk. It hits them every time, and then we have to catch them up. It's unexpected. And most accountants ignore that. Well, you know, there's no deduction, so I can't do anything about it. We're not going to deal with it. Here's an S corp. The beauty of an S corp is we take the stream of income and we put it into two. We split it. We have a salary, which has got to be a reasonable salary, and you still pay the 15.3%. Half is paid by the S corp, half is paid on your W-2. But the magic is the portion that's business income that totally eliminates any self-employment tax in that portion. So let me give you an example. That 80,000 person. And we're going to, look, it doesn't mean you do it this way, but let's just assume it was 40,000 salary and 40,000 income, just to make it easy. The $80,000 person paid self-employment tax of $11,304. The S corp paid self-employment tax of $6,120. That's a $5,000 savings. And this Cincinnati is real money, especially for somebody making $80,000 a year. And that's year after year after year after year. So that's $25,000 over the next 5 years.
Does that, when you get old and retire, are you
Yes.
paying less to screw yourself? Are you screwing yourself?
So it's very important when you look at this. There's sort of a curve.
Okay.
The first $20,000 of earnings that you put into Social Security account much more, give you much more return than 100,000 to 120,000. So it's important to look at the curve where it makes sense to set your Social Security up. It's a significant savings. And I will tell you, I have plumbers as clients who make $60,000 to $90,000, and when I can save them $5,000 a year, and it's a savings. It doesn't, it's not like I'm saying put $5,000 in equipment or put $5,000 in 401k. I'm saying put $5,000 in your pocket.
How are they getting the other 40,000? I mean, if the first 40,000 came out as salary,
What
you just write your
happens-
check for 40?
You'll pay tax on that, whether you take it out or you don't.
Right.
What it's getting at is you set up, instead of being a sole proprietorship where you go out and fix people's computers and people write you $100,000 worth of checks, they write your business $100,000 worth of checks and you pay yourself a salary of $50,000 and your business makes $50,000 and you're only paying Social Security on the $50,000 that you write yourself as a paycheck.
Right, and I get that. I guess,
So how do you take the money out?
how do you get the other
You
40?
either pay it out as a dividend or you leave it in there.
Gotcha, okay.
It's your money. It's your, or whoever the owners of the business.
Right, okay.
If you have partners, then you have to divvy it up. All right. So that's the old stuff. So let's go over again how businesses work. We'll go from the beginning so we understand how we do taxes. So again, you add all the income from all the sources. And again, if you have illegal income, you got to add the illegal income. You subtract your cash expenses, right? That's your salaries and wages, your rent, your utilities, things that you keep track of during the year. Then you subtract your non-cash expenses,
What's that?
like depreciation. So depreciation or amortization. If you buy a building or you buy a big piece of equipment that lasts for 5 years or 7 years, you can't deduct it all at once. You have to deduct it bit by bit. Usually you guys don't keep track of that. You wait till the end of the year and your CPA says, here's how much your depreciation was. Finally, you calculate your tax. If you're a C corporation, the C corporation pays the tax. If you're any of those other corporations, it passes the tax and any tax credits through to the owners. You'll see K1. And it'll pass it through to the owners, and you'll deduct it it'll show up on your personal income tax. All right? Okay, so this is C corporations. Now, since I've been in a CPA, or since I've been in practice, I've never recommended a C corporation, or not for main business. The answer was always partnership or S corp. The only reason you went C corp is if you wanted to become the next Intel or Google or something, if you wanted to go public. Now, DLP was a C corp, but that's because it was started before S corps were in existence. And that's when you'll see guys that have been out of manufacturing plants who have been around for 40 years. They're C corps, and everybody younger is an S corp. So here was a C corp rates. It was, look at this. 15%, then 25%, then 34%, then 39%, then it goes down to 34%, then it goes up to 35%, then it goes up to 38%, and down to 35%. Thank you, Congress, for this logical.
Is the rule about C and S, you can start out as an S and change to C, but you can't go backwards, or how's that?
There's limitations, but no, anything can be changed. But sometimes there's limits on how long you can do it. So these corporate, then there were other rules. So a personal service company, somebody who's a consultant or an accountant, or God forbid, a lawyer or a medical guy, they had to go right to 35% because there was a special rule. If you had a personal holding company, that's a company that invests, that gets most of the money from investments. They want to make sure you didn't get the 15% rate. So there was a new rule for you. You had to be 35% from $1. There was a corporate alternative minimum tax, that looked like the individual one, and there was an accumulated earnings tax. The government wanted to make sure that you weren't like Scrooge McDuck and having a ton of cash you were swimming in. They wanted to make sure the money came out of the corporation because a C corp is double taxed. One at this rate, and then you get the tax when they send the money to you. So it's 2 levels of taxes. The new rules are different. 21% down the line from $1. If you're a consultant, you can be in a C corporation. You still get this 21%. Corporate alternative minimum tax, they couldn't get rid of for the individuals, but on the corporate side, it's gone.
And this is C corp only?
This is C corp. Okay. Because on the pass-through entities, all those rules pass through, you had on your individual. So now, if you're taking money out every year, if you've got a business that's to feed you, S corp still makes sense. But it's not as big a difference as it used to be. If you're trying to build the next Google, if you've got a car lot and you're trying to build it into the next AutoZone, if you want to grow, if you're keeping the money in the business, C corps makes sense to me. It's not something I do for some kind of crazy reason. C corps makes sense. Very different. But it's still more expensive when you're pulling the money out. And there's some other things you can do. There's some small business rules. C corps can be very interesting. But let's talk about what most of us have. Most of us have small businesses. Most of us have proprietorships or partnerships or S corps. I'm guessing you have an S corp.
I am an S corp.
All right.
I think
You are not an S corp. You have an S corp.
I am, right. And Kevin, you are too, right?
Okay, so we've always had different kinds of income. There used to be ordinary income and investment income. Ordinary income is your business, your sole proprietorship or your earnings from work. Investment income was like interest and dividends and capital gains. And you'll notice that this sometimes has a lower rate of tax. But also, capital losses can only be used against capital gains. You can only use $3,000 of capital losses against your ordinary income every year. So there's sort of a silo. It's that investment income can't be 100% used against the ordinary income. You can only use it a little at a time, $3,000 a year. Robert, we've talked about this. So you've heard this is the biggest tax change since 1986. In 1986, they came up with passive income. The idea was that people were getting around this silo by setting up real estate partnerships, real estate investments. And they were using all the losses from real estate against ordinary income. So Congress said, aha, we're going to make a third type of income called passive income. And we're going to protect any losses here from going here or here. And that's true. If you have passive income, you can't take your losses unless you make under a certain amount, and it's worth $125,000 a year. Gets real estate investors all the time. So 3 wasn't good enough. Now we have 4 kinds of income because we were making it simple. Qualified business income. I like to call it qualified pass-through income.
Hold on, what?
Qualified pass-through income. The big deal about qualified pass-through income is 20% credit. If you make $200,000 in your business, on the income side, not your wages or your guaranteed payments, if you make $200,000 in your income, you get a $40,000 credit. If you make $2 million in the business, you get a $400,000 credit. I don't do Trump very well, but this is huge. It really is. It's a big deal. As corporations always save money on self-employment tax, now they're going to be able to save you money on income tax. It's called a Section 1, I know you guys came here for jargon, right? It's called a Section 199A deduction. So talk to your CPA, you go to folks who have one, technical professional, ask them about a Section 199A deduction. And I've got a few slides on this, it's very interesting.
So this is all, when it says qualified businesses, do only certain businesses qualify, like hotels?
Give me a second. Give me a second. Yes, no, maybe, depends.
And when you say huge,
Oh, is that, okay, there you go,
you
huge.
make the sign that he makes.
It is a very big deal. All right, qualified business income, again, only for S Corps, partnerships, and sole proprietor, because these are the only ones that pass through. The C Corp already got their rate jump from 35 to 21%. These guys are still at the personal rates. So it's a credit to become more like a C Corp. All right, so if you make under $157,000 taxable income on your individual taxes for single, or under $315,000 for joint income, you get the credit. There's no hurdles. You have $100,000 of income, and you're married, and you have $100,000 of business income, you get the 20% credit against your business income. I don't care what kind of business it is. I don't care how many wages you have. You get it. However, if your income is over these amounts, then you've got 2 significant hurdles. Unfortunately, I think some of these hurdles impact the people in this room. First of all, there's the 50% or 2.5% rule. Basically, that says you can only have a credit up to 50% of the wages that the company pays, or 25% of the wages plus 2.5% of the capital invested in the company. That was for 12. That handles your real estate companies. As an accountant, I can teach you how to get around that. That's an easy one to get around. If you don't have wages, you become an S Corp, you pay yourself a wage, and you can get the credit.
Okay. So this 157.5K is per individual.
Personal tax, right. So let's say we have 2 lawyers, and they get $100,000 of income. Oh, that's not. 2 individuals that make $100,000 of income, of partnership income. One that's his only income. The other partner has a wife that makes $300,000. Partner A is going to get the tax deduction on his portion. Partner B is not.
Okay.
So the other rule is if your QBI, qualified business income, comes from a specified service business, it's not eligible if it's over this amount. A specified service business is medicine, law, accounting, actuarial science, financial services, consulting, performing arts, athletics, or any business that relies on the reputation or skill of one or more employees. It certainly kicks me out.
All businesses?
No, not all businesses.
I got you.
Not all businesses, but service businesses.
Like a burger flap is not gonna.
No,
have
Burger
that.
Flap's not, a retail store is not gonna have this. Now, two items that were, remember, President Trump is in the business of real estate development. The two professions that seem like they depend on the reputation and skill of the employees that were specifically excluded were architects and engineers working in construction. What a coincidence. All right, here's pizza here.
It's gonna be 5 minutes.
So,
Can I ask a quick question?
yes, please.
Is the business type for if you're over the 157th
Yes.
Street? Okay.
So if you are a service business, if you're a consultant, if there's no way against around that rule, it is incredibly important that you manage your income to be under 157.5 single or 315 joint. Well, how do we do that?
That's easy for me.
It's easy for you.
Right.
If you find yourself over it, you might, if you're married, you might do married filing separate. Let's say you're married and you're going to be at $345,000 this year. Might be a good year to make a charitable donation, a big one, if you've been thinking about doing it.
So this taxable income is after deductions type of thing.
It's after itemized or standard deduction,
Okay,
but before the business deduction.
right, okay.
I did a scenario where somebody was making $200,000 in business income and $345,000 in taxable income. Decided to make it, they need to put $20,000 into a charitable foundation, give to their church or their charities.
When you say before expenses, it's before the business's expenses. Right?
Sorry.
You said after deduction before expenses?
Before the business
Okay, before
deduction.
business.
Before this credit.
Okay, gotcha.
Before this credit.
Okay.
So you can't use a credit to determine if you count for the
Right.
So, in this scenario I worked on, that $40,000 business charitable donation only cost $20,000, $22,000. Because even though they were only in a 25% bracket, they were getting 48% tax deduction on their thing because they were right around this level. Really important if you're in a service business to control your expenses and keep under them. You can do it through buying equipment, you can do it through retirement plans, you can do it through charitable donations, but you want to be in the range there.
Software
Yeah.
license.
Yes, buy software licenses. Who sells software in this room?
I occasionally actually do move some
All
software.
right, all right. So, what if you can't do that? What if you got a really successful business, you're doing $500,000 a year? All right, what else do we have to work with? If you need the wage income, that was the number one, consider establishing an S corporation. That'll work. And this is where accountants and lawyers, we're getting really creative. How do we work around these crazy rules and get our clients this deduction? Because the deduction is so big. You can segregate non-service income into a separate activity. Consider cracking and packing. Crack out ancillary services into a separate activity or company, or pack non-service activities into a single entity. Right? So if you have a doctor and he owns a pharmacy, or he's doing injectable drugs and he sells that, and he's buying it, maybe the purchasing, you set up a separate company to purchase those drugs and resell it to the doctor at a profit, and you crack out some of those earnings. Now, don't go to your CPA and call it cracking and packing. They won't know what you're talking about. That's not what you're talking about.
That sounds like a drug dealer.
So that's interesting. Consider developing a position paper showing your business does not primarily rely on the reputational skill of one of your employees. And I'll go back. I think if we're the kind of VAR that DLP was, and I'm going to run through some numbers, I think you could have made an argument that you're not a service company. Before we hit that, consider separating real estate to a separate entity that the business pays the highest reasonable rent to. Right, now you can run that out. You have a real estate building, you spend $500,000 on it, you pay rent to that building, they make profit on the rent. That's not a service activity, that's a building. So
Say
you get
pay
the
rent
credit back.
yourself.
To another end? Yeah.
Okay.
You have the business pay rent to the entity. If you can't realize these rules because you're an employee, consider quitting your job. And I'm not totally facetious. If you've got one guy making $100,000 a year who's employed, and another one making basically costs the same to the employer, $113,000 a year, because the employer doesn't have to pay Social Security, and they're netting $100,000. Mr. Employee is paying taxes on $100,000. Mr. Independent Contractor is paying taxes on $80,000. You might want to go back to your employer and say, let's renegotiate. Some employers will say no, but it might be an idea. You need to think of other things. There's a lot of benefits to being an employee. You get health insurance, you get benefits. So you need to really think that through. That. Yes, sir.
You want to pick a point to take a break?
Take it right now.
Okay. I didn't want to interrupt you.
No, I got about one more thing here, and I'm going to go through our industry.
We'll reconvene.
Excellent. I get excited. This is like the most exciting time to be a tax accountant in the last 30 years. But for some reason, most of the public does not get excited to go home and read tax code. I don't understand why, but you guys don't. So I can talk about this forever. All right, look. Where's my book? So let's go through how you could do a position paper and take a company that looks like a service company and actually turn it into a non-service company. So let's say you had a reseller that did about $3 million in product sales and about $1 million in service sales. How do we convince, you know, people are buying from you because of your reputation and your skills. How do you convince the IRS that that's not a service business? Here's how I would do it. Here's the paper I would put together. Here's the research I would do to make that happen. The $3 million in product sales, I would say, is from the value of the brands we're selling. IBM, Dell, HP, and, you know, Microsoft, Cisco. Because you can make the argument that these are billion-dollar brands and I'm one or two guys, or three guys, or whatever, however, a 20-person company. Obviously, the brand is more valuable than me. I know you don't like to put down the value of your services, but sometimes you have to make that argument. It doesn't matter because you're probably not making nearly the profit on the resales of the $3 billion as you are on the services of the $1 billion. Well, I remember when we were together, we spent a lot of time and effort turning ourselves into a managed service business. We spent a fortune on management software, ticketing systems, and I don't know if people are still doing this, but tracking systems. It was enormous. And then we spent lots of time building procedures around these items. So I would make the argument that when we were selling managed services, we were no longer selling our engineers' skills and our reputation. We had turned it into something different. We were selling the product that we had developed. So let's say that's 60 or 70% of your service revenue. That leaves 30% that's consulting. There's no doubt about it. Well, you could make the argument that the portion of the consulting was not the major part of the business. Would that fly? I don't know. Would that pass an audit or court? I don't know. But certainly, if you had a position paper put together, you could make an argument that you were being reasonable, and the IRS might disagree with you, but there shouldn't be a penalty because you had a position. Let's take that same scenario and say, Mark, that's too aggressive. I don't want to do that. We can do the same thing by splitting those up to separate entities, right? If you've got an entity that does nothing but sell products, and you put some salespeople over there, it's hard to argue that that's, you know, the reputation and skills of your employees.
Sales guy might disagree with you.
Sales guy might disagree with you, but I think you can make the argument because that's a resell. It's like a retailer. The guy at Best Buy might say it's my salespeople who are telling you what to sell, but it's really because you're in retail. So I think I do a lot of work with real estate agents. I do a lot of work with some of the trades. I think this industry is most ripe for making a good decision. But I gotta say something here, and it might sound like I'm tooting my own horn, but this is not for amateurs, right? TurboTax doesn't have a button. How do I split up my entities to get the 199A deduction? If you're simple, if you're inside the box, absolutely. The taxes are getting simpler. You get a W-2 wage. Utilize some of the software out there. Go down to Office Depot, buy TurboTax, go online. But if you're trying to maximize a 199A deduction, this is complicated stuff. You need somebody that can fight the IRS on your behalf. You need to have stuff ready to go if you want to save the most money. All right. Are there any other questions about 199A deduction, that 20% credit? It's big, 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 big. Really important. You control your income, or you figure out a way to run through those hurdles. All right, so here's some other item changes in the tax law for corporations. Depreciation expensing. You guys understand depreciation. You buy a front loader, you buy equipment, you buy a building, and you have to depreciate it over the year. You can't expense it right away. And we've had Section 179 that allows some of it to be expensed right away. We had something called bonus depreciation. Bonus depreciation in the first year has been increased to 100%. So any asset that you could buy under bonus depreciation, it doesn't matter if it's $1 million for that asset, you can write it off this year. So if you don't have enough money to buy it, go to Ian, and Ian will be happy to finance that item for you. And especially towards the end of the year where you're trying to control your items, it makes sense. So what's not included in this bonus depreciation? Real property is not included in this depreciation. Improvements might be, but if you want to buy, the Crew Tower, you can't write it off right away. Listed property. What's listed property? Vehicles. Vehicles are not going to be covered by this unless they're so large that they're no longer counted as listed property. So if you want to buy a tractor trailer, you're good to go.
So you're saying that you can now depreciate 100% of a vehicle in the first year?
No, I'm saying the vehicles don't count.
Meaning you can expense the vehicle?
You can't deduct, you can't expense the vehicle in the first year. That's one of the exceptions to this 100% bonus.
Oh.
Listed property is not included and real property is not included. But everything else is.
This real property doesn't mean just real estate then?
Yeah, it means real estate.
No. So
Listed property and real property are not included.
does listed property mean,
Vehicles.
listed property means vehicles. Helicopters. So a server or a computer is
Absolutely.
is expensible.
Yes. And a helicopter. You said a helicopter?
He said helicopter.
Helicopter's good.
Is it not listed?
It's not listed.
So why is a helicopter listed, not a car? Okay.
My job is to be a Sherpa. I don't say the mountain should be there or shouldn't be there. I don't say it should be this shape. My job is to look at the shape and get you through it as best as possible. Let me make sure I'm on the right. Look at my notes here. It took me longer to put the notes on little note cards than it did to do that presentation.
But how do you figure out whether you have equipment that can be depreciated 100% first year?
Say it again?
Depreciation, you buy, let's say, a big generator or something, you're going to depreciate.
Yes.
Would you say you could
I want to appreciate that 100% the first year.
right, but why would you want to not do that?
There's no reason.
Okay.
There is a reason. If you're not making much money this year, and you want anyone, but it doesn't matter because you're going to be able to carry forward losses. So there might be a reason, but this is big news. This is, and I think you're seeing a boom in capital improvement. That's the whole idea. By the way, it doesn't go forever. The percentage drops to 80% and the stuff you buy in 2023, 60% for the stuff you buy in 2024, 40% for 25, and 20% for stuff you buy in 2026. So you need to get this in. And if you're going to double or triple your company because you're going to buy all this equipment, if you're going to become a new rack space, you buy tons of servers, you need to get it done before January 1st, 2023.
So Trump plans on buying a new airplane.
Just going to write it off, 100%.
Of course.
All right. Any questions? Pretty obvious. But this is a great way to control. Remember, we talked about controlling your income. This is a great way at the end to control your income. Business interest. You might have heard about this. Businesses used to be able to deduct 100% of their interest costs. Now they're limited. It's going to hurt real estate companies, but it's only going to hurt companies that are over $25 million in sales. So, is there anybody here over $25 million in sales?
$1
Million.
Legally? Oh.
Reporting sales. Or illegally, as long as you're reporting. And there's all kinds of provisions. It's not that big a deal, but there is a limitation on that end. Business entertainment, we talked about, you're asking me about expenses, so this is important. So part of our things, we always encourage our clients to be more aggressive at deducting meals and entertainment. Well, some of that went away. We know that entertainment used to be able to, take somebody out for a golf game, or take them down to the ballpark, or as long as you had a bona fide business meeting before or after, you could deduct the whole thing. Absolutely 100% not out there anymore. You can no longer deduct entertainment.
So zero.
Zero. However, we also know that you can still deduct meals. You go out, you have to have a business trip to California to meet so you go to Washington to meet Redmond to meet Microsoft, you can deduct your meals.
What about the alcohol?
And you can deduct the alcohol. Here's what's getting CPAs in a frenzy. Is if you take your client out or your business associate, if me and I go out and talk about one of your guys' businesses that's mutual client, is that a meal or is that an entertainment? Is that a 50% bona fide meal? We're talking business. Or maybe I'm with a client and we're doing a deal. Or is it entertainment and I'm entertaining you? We're split. I'd say more than half of the CPAs feel that that's an entertainment and that's gone. But I've got legal opinions that say, no, it's still a meal. This is an interesting thing.
What's the contention point is if you're not talking?
You're eating with you're having a meal at down at what's one of these fancy at Jack's.
Oh, you mean at the casino?
No, at Jack's. You're meeting at Jack's and you're with your business. You're with a prospect, or you're with your client and you want to ask for referrals. It's a bona fide business purpose, but are you entertaining your client or is that a deductible business meal? So there's a California company that came out with an idea that said, we talked about this in a little meeting. Believe it or not, tax accountants have these little meeting groups where online. It's ridiculous. More than half the people say it's not going to be allowed. I believe it is going to be allowed, but and that's where you can see the risk assessment of different CPAs. I tend to be more aggressive. We're letting my clients take risks, but make sure I have some legal behind it. Sometime during this year, we expect the IRS to come out with this will be a lawsuit, I guarantee it, but with guidance. If the guidance goes against me, for my clients, it's not worth going to court to save a $5,000 meal and entertainment deduction. So I'm going to advise my clients not to deduct. But if there's no guidance, I'm tell my clients to keep on deducting.
So the conservative CPAs who are saying it's not, what is their criteria for saying that it isn't?
Their criteria is, and there's something in the code, there's 2 sections of code. They changed one section but left another section there. So there's actually an argument both ways. It's just not clear on how they changed it. You know,
In other words, they
it's
changed.
whether, see, everything used to be meals and entertainment. It was never broken down, this is a meal, and this is an entertainment. So that's where
They split it up.
How does the split work?
Yeah.
And talk to your CPA, you'll find out where he rests.
I foresee a cottage industry of entertainment clubs that sell meals so you can say it's a meal.
Well, but that might not even work. That might not even work. You know, there's a lot of, we'll talk about it in a minute. But anyway, you said you had a question about business expenses. What are your questions?
So when I started out, so my dad ran a business. It was probably a C Corp because it was the 80s, right? I wouldn't
Right.
have S Corps invented. I don't know. Anyway, it was in the early 80s. It's in the 70s and 60s. And he ran a corporation, and all of his cars were always in the business's name. And I worked for a guy for several years, and he put all his cars in the business's name. And then when I started out, I talked to a CPA, and he's like, "Oh, you should run everything possible through the business. Every single thing possible that you can run through the business, you should run through the business." And my current guy's like, "No, that really doesn't make a difference. Just take your personal car out and keep track of your miles. We'll deduct your miles, and it kind of comes out in the wash. It doesn't make a big difference." What's the skinny on that? In your opinion?
In my opinion, you can do it either way. But if you're an S corporation like you are, you're an employee. So if you are asking for reimbursement of your miles, you need to have something called an accountable plan. So your employee is accountable to the company. And as an employee under the accountable plan, you need to do a timesheet to yourself or an expense report to yourself where you actually reimburse your miles. That's the proper way to do it.
I have my company pay me for the mile instead of just doing the 53.5 cents.
Yeah, do 53.5 cents, but it has to come through as a reimbursement on an account. Just like you or any other employee working for a company. When your miles in, you send an expense reimbursement, and you get the money back. I don't want to talk too much time with that.
Yeah.
Because it's pretty specific, but as an S Corp, that's how we handle it. That's how we tell our clients they handle it. We think it's the most audit proof. We also set up a formal document of an expense accountability plan, and we actually usually do it, we do some paperwork to show you're an employee working for this business and how we come up with a compensation. Because we've been in audits, and we go against the IRS and we know what they ask for.
Okay.
Here's something else on employees. You used to be able to take 100% of the cost of providing food and beverages to your employees. To an eating facility that qualified as the minimum fringe benefit, it's now only 50%. So some of the meals that you give to your employees and you're able to deduct 100% of, now you're going to deduct 50%. I think that means your coffee service, you can only deduct 50% of. I also think nobody's going to care. All right. We're getting some of the weird stuff. Before I do this, this is something I don't have a slide on, because this is something I learned the other day. The IRS, if you want to be a cash-based business, it used to be limited, now it's up to 25 million. Also, if you keep an inventory, I can't almost believe when I say this, you used to not have to keep an inventory on accrual. You could be a cash-based inventory if you were small enough, but not if you were in a retail or wholesale trade. So let's say if you were a plumber and you had like some supplies inventory, you didn't have to keep a formal inventory. And not only has it increased up to $25 million a year in sales to be cash basis, but they're also saying even if you're a wholesale or retail trade, even if you're a store, you don't have to keep an inventory for tax purposes. You can write it off as fine. I think it's the dumbest thing a store could do. They'll have no idea what the profits are, but it's allowed under the IRS. Something interesting and different.
No longer have to keep track of it, or I'm kind of missing what you're getting at.
So somebody who has an inventory, you look at your beginning inventory, look at your ending inventory, you take the change. So if your inventory went down, that means your cost of goods are a little higher than your purchases. If your inventory went up, your cost of goods sold is a little less than purchases, because you're tracking what you have sold.
Always.
Your IRS is saying, even if you have a store, you don't have to do it. As long as you're selling under
But
25.
doing it always pays because you
Yes.
make money with it, so.
Well, also you track how much you're really making. All right, this is fun. The new tax bill denies deductions for any settlement, payout, or attorney fees related to sexual harassment or sexual abuse if the settlement includes a non-disclosure agreement. Think about that.
Hold on, rewind that. I couldn't. I missed.
So if you're Harvey Weinstein, and you have to pay out a lot in sexual harassment rules, you can't deduct it if you have a non-disclosure agreement. But if you don't have a non-disclosure agreement, you can take it off your taxes. I'm only one vote, guys.
That's because
I don't know where they come up with this stuff.
Huh.
All right, but it's just a funny thing. Net operating losses. This is the, you heard about Trump made all this money and he didn't have any income tax payable because he had net operating losses that were carrying forward. But they changed the rule. If you have a loss in your business, you never want to have a loss. But if you have a loss, you were able to take it 2 years into the past and get a deduction right away, and 20 years forward. Now you can't take it past. You can move it forward indefinitely. But you can only reduce your income by 80%. So if you have net operating loss carry forward, it can't totally mess up. Just interesting. Estate taxes. And by the way, this is under the current rules from 2017. Estates were subject to a 40% estate tax. However, also gifts are unified. So gifts were subject to 40% estate tax. However, everybody had a $5 million per person credit. So your first $5 million of gifts or bequests are not covered. So they didn't get rid of the estate tax, but they doubled that credit to $11.2 million per person. So the next person who wins the Powerball, you want to give money to all your friends, you can still give up to $11 million per person. It doesn't impact me, I don't know. Ian, probably,
Buying a ticket only slightly increases your chances of winning.
Just you guys might like this. Code section 162 says that members of Congress conduct up to $3,000 per year for living expenses while they're away from their districts. That's gone. They no longer get that deduction. I'm sure we're all heartbroken. Now, this is
So they get it all now?
no, they don't get anything.
That's their token tax
Yes.
thing. Some people go, well, look, Congress is doing the right thing.
All right. Here, this is just weird. This is petty and
Oh,
mean.
look at this.
Have you heard about this?
I
No.
haven't because there's nowhere for me to ride to.
Okay. So there used to be, you could get a benefit from your employer of $20 per month for commuting on a bicycle. All right, it was a nice little thing. It cost the government $1 million a year. Now, that sounds like a lot, $1 million. But this is the United States government. They probably spend more than that on coffee service. They probably spend more than $1 million on the little sticks that you use to stir the coffee. It makes no sense at all. The only thing I can think of is there's some staffer or there's some congressman that had a neighbor that pissed him off. And he's been waiting to get back to this guy for 15 years. And I don't know, his bike ran over his pet chihuahua or something, and he finally got it. Because it's the silliest, pettiest tax.
So it's something they got rid of.
They got rid of this. It cost them more to write up the law than $1 million they'll save. You might have heard that Obamacare was repealed. It's not. It's not. There is an individual responsibility payment that not this year, but in 2019, you won't have the minimum. If you don't buy insurance, you just have to pay $967. The fine's been put down to zero. The fine's still there, but the fine's zero. However, the rest of the law still exists. The requirement for employers over 50 people to pay insurance for their employees or have a penalty, rules on insurance companies, all the rules still exist. They just took away the individual responsibility payment. They didn't even take that away. They just reduced it. Not for this year, not for next year, not for this year, but for next year, 2019. All right, so here's my little self-promotion thing. Where do you go from here? I know most of you guys have CPAs, and that's great. What we do is a process called tax planning. And most of a doctor does. A doctor will put you in, look at tests, they'll evaluate you, they'll come up with a plan, and then once you have that plan, you'll execute it. Buy drugs, you'll go get a surgery, whatever the plan is. Then after it's done, they'll have you come back and see if everything's done. We do, I hate to call myself a doctor, I'm not that good, but we do something similar when it comes to taxes. We look at your last couple of years, we evaluate it, we evaluate the plans, we come up with a plan to save money to the future. It's a separate engagement from doing your taxes, it's like a planning engagement. And then once we do that, once we have the plan, then we execute the plan. Once it's executed, we have to come back in the future to make sure everything's going well. All right. Love to meet with some of you. I understand you guys are your own CPAs. I hope you guys got some benefit out of this. Is there any other questions? Yes, sir.
I have a question on the Obamacare item. Do Obamacare in private military?
Okay.
They have like TRICARE.
Yes.
You don't pay for. In 2 years, do I get screwed?
No, you're covered. So the only thing changing is I have clients who, for whatever reason, stubbornness mostly, don't buy health insurance. And if they're low income, they could be covered by Medicaid. But they don't go to Medicaid and get insurance, and they end up paying a fine. You're not in that situation now, and I doubt you're in that situation in the future because you're covered under TRICARE. All right. Now, does that mean that TRICARE is going to cost you more? I have no idea, because that's not part of this. But there should not be a change.
Question for you. It seems to be a time limit from what I understand on some of what they're doing.
Yeah, so
2026 is kind of like
that's right. So the
flag drops and a lot of things.
Yes,
The Democrats are lining up and they're happy because it's going to go back to business as usual.
I don't think anybody's going to be happy. So because of the budgetary rules, they gave a lot of money to corporations. Then they want to give a lot of money to the rest of us. Then they've tried to pull some things back to pay for some things, but it's increasing the deficit. So they can only make these provisions last until a certain point. We've seen this in past laws where you hit this fiscal cliff. So in 2026, they're going to have to make a decision. If they don't change it, everything goes back to the way it was in 2017, except the business credits. Those are permanent. I don't think they're going to want to do that. But I don't think we're going to get to keep everything. Knowing the way things work, it'll probably be the Democrats in power at that point. And Democrats are like, well, this stinks. You guys are setting us up. Because we know we're going to have to deal with this in 2026.
They got borrowing's up 84%.
What?
I said government borrowing is up 84%.
Yeah.
To pay for the tax cuts.
I don't know how we pay for this. But again, my job is not to determine the size of the problem or its shape.
It doesn't matter which administration it is, they've always not been paid for.
That's almost true. That's almost true. I can't, this comes up at work all the time, and I have to be very careful.
You have to remain agnostic.
You got to be agnostic. You can't. Whatever my feelings are, it's not really what my work is. My work is to, without fail, try to get you guys to pay more taxes. If you want to pay more taxes, that's fine. Probably not going to make a good client.
Or have your mother-in-law do it.
Or have your mother not do it. Which I'm sure is good.
Now you need to ask your mother.
Yes, sir.
That one slide you had, that you could submit a letter to get a deduction.
I call it position paper.
Well, position paper, will the government review that every year?
No, I would not even send it to the government. I would fill out the taxes based upon that, and I would have it in my drawer. And it would not just be a letter. It would be, we try to get court cases, we try to get, we try to build a position, a legal position. Not that I'm a lawyer, but I'm in front of the IRS. I can practice before the IRS, so that if you were ever audited, here's our reason. Just like when we set up an S corporation, we determine what a reasonable salary is. I don't just guess. I have some research that I put together, so if it's ever attacked, at least I have a reasonable position that's been laid out when we first did it. So if they come attack me 5 years from now, you know, well, here's why I did it back in 2017. And here's why we made these changes. We think this is reasonable. Why is it not reasonable? That's a lot harder for the IRS auditors to attack than, why did you come up with this? I don't like it. Because now you say, here's why I came up with this.
I had a friend who got injured, he was a policeman, so they gave him a disability in lieu of retirement, which he got paid on every year, and he got a letter from a federal IRS person in California, and he submits it with his tax return. All of a sudden, they go, that doesn't apply anymore. And he said, well, I got it from a federal tax person, you know, IRS person in California, and the person here in Ohio goes, the California federal rules don't apply here.
Wow, that's okay, but I will tell you that you cannot, there are things that we can rely on. And I want to talk about the different kind of tax practitioners also. There are things that we can rely on as proof. There are different levels of what we're allowed to rely on as justifications. Something specifically excluded is our IRS representatives. So if it's not a pronouncement or a letter or a notice from the IRS, it doesn't count. Even the publications aren't fully proof. So I want to talk about the different kinds of tax practitioners. There are lawyers, tax lawyers, there are CPAs, that's what I am, there are enrolled agents, and there's everybody else, tax practitioners. A lawyer is probably at the top of the charts. A lawyer can do your taxes, but what they can do is they can take the IRS to court and they can practice for the court. A CPA, so a lawyer is ruled by the states. A CPA and a enrolled agent can also practice before the IRS, but I can't go past appeals. I can go to collections, but I can't go past appeals. When we get to court, I have to hand it over to an attorney. But we're cheaper than a CPA has a broad base of knowledge, again, by the states. So we know mortgage taxes, we know, about accounting and balance sheets and income statements. But some of us don't do a lot of tax work, so we need to make sure that your tax CPA is actually a tax CPA. An enrolled agent is registered by the federal government. They are enrolled with the IRS. They have probably the easiest test to get their exam, but it's still a tough test. Every enrolled agent I know is very, very solid and knows their stuff. They tend to be, compared to a CPA or attorney, they tend to be more in what the IRS says is right, and they don't less likely to go to court to see exceptions. They also tend to be less, because they don't have formal training, they tend to sometimes be not as strong in companies' balance sheets and income statements. Any of those three are great people to work with. The trouble is tax practitioners, somebody told me somebody had a bookkeeping service, and it might not be CPA. Trust us. The attorney, CPA, EA, those are tough things to become. We're proud of it. I put CPA all over the place. It's on my card, there's like a plaque on my wall, you can't get away from me and not see it. Everybody I know is a CPA is the same way. If you're not an EA, a CPA, or an attorney, you can do taxes. And some people have been doing it forever and they're probably pretty good at it. So they're not necessarily bad at taxes, but they cannot represent you before the IRS. And if you're paying somebody to do it, you might, it doesn't even cost more to hire someone that can represent you.
You have to take a test every year to recertify or every so often?
I don't have to take a test every year.
CPEs.
You have to take CPEs. And the reason Tom was out of the public accounting game, I had to take a lot of CPEs to get myself back there. So I am well over the minimum requirement every year. But I'm not, the reason I can repeat is because I'm specializing in a certain type of clientele. I'm hitting small businesses and independent contractors. I'm competing against CPAs that have been doing this for 30 years. And I find mistakes because they got a broader base of clients. And that's me.
I'm not certified in anything anymore. After DLP, I ain't certified in nothing. You remember SCO?
Yes, yes.
I was certified in SCO and I was certified in Novell, and look where they are today.
Yes. Stop being certified.
Yeah.
Is there anything else, guys? It's been really a pleasure enjoying you. Thank you so much.
Thank you very much.
One thing, I got these like evaluation sheets. Would you guys mind filling them out?
Sure.
Send them out.
For $1.
This one here.